When you first become an investor, you're always told to follow big money because they tend to move the market. So today we're going to be looking at big money and where sentiment currently is. Are they bullish or are they bearish, and where do they see the market in the next 12 months? With PCE and GDP data due next week, how big money looks at the market currently will determine how they react to those data prints initially. We'll also be talking about earnings. We have a dense week of earnings ahead with one particular sector in focus. Welcome everybody to a special weekend edition of the show. My name is Chase. So if you like this video, please subscribe and hit that notification bell. Guys, let's get into it. Now, this is a weekly heat map of the S&P 500, and you can see the fever was risk on across the board. Semiconductors, technology, consumer defensives, healthcare, everything posted pretty green results. Energy was pretty mixed. Tesla was pretty red on the week, and this small section here in comm services, entertainment, was pretty red. But other than that, we're looking at a very green week across the board. Apple did let down technology a bit, but considering where the sentiment was Monday, Tuesday, and to see the results we got at the end of the week, kinda astounding. And a lot of that had to do with the Nvidia trade and their earnings. Now, let's actually hop on the charts. Now, looking at the S&P 500 weekly chart, just zooming in right here, there's a couple of notable things that we can identify. Now, starting with candle structure and location, this is a bearish engulfing candle closing in the top 1/3. We did see quite a bit of selling here on Friday. That's because of the gap up and then sell off. That being said, still a positive day for Friday, as you can see. Bulls found value at the week's lows, which was similar to the week's lows the week prior and the week before that as well. So it seems like this area right here, call it 49.20 to 49.40, seems to be a very good area that bulls take advantage of, looking for higher price action. Now, this candle is extremely bullish considering where it actually closed. It didn't just wick above. The weekly close was an all-time high close, but it closed significantly above the previous week's wick high, and that's insanely bullish. There's nothing about this chart that tells me things are gonna break down. Look, we made a low right here, and another higher low. Now, you could consider this the next highest low, but I personally give significance to that right there. At the same time, we're just making highs, higher highs, and then new all-time highs each and every single week. And we've made a new all-time high every single week ever since we made the all-time high record in late December right here in the S&P 500. And on a weekly chart basis, we can actually afford a pullback all the way to the 47.80 area. And until we actually break below this, we should be eyeing opportunities, looking for bullish demand all the way to 5,100, 5,200, even 5,000. So we can pull back as far as 47.80. And if we're actually to measure that from the close to where it is to the bottom, it's actually 6.04%. So we can afford a substantial pullback and there will be no technical damage in the chart. Now, the reason why this is very important and a key zone is because if we actually zoom in, it was the previous all-time highs that we made here in 2021. Resistance becomes support, and again, unless we actually go ahead and break that key level at 47.80, I probably won't get bearish on a weekly basis. It's a little bit different on the monthly chart, but we're going to talk about that next week because that's when we have the February monthly candle close. Now, looking at the daily chart, zooming out quite a bit, now you can see this is the 47.80 area right here, and on the way down we would actually be taking out this low, this low, this low, and on a daily basis it does look a bit different than the weekly chart. We can see sustained weakness in the daily chart if we actually go ahead and break this level right here, call it 49.44. Now, on the daily chart we can actually afford pullbacks all the way to this area, and if we do pull back to this area, I will be eyeing opportunities for us to go higher. If we do break below the 49.44 area, this is where things get a bit dicey. We can see further sell side to lower levels, but it is a long way until we actually get to this 49.44 area because we currently are sitting at 50.88. Now, looking at Friday's close, I did speak about this on Friday's video. We actually gapped up to this level right here, sold all the way down, and then buyers did find a bit of support at the top. Sellers did take us lower, but we did finish positive on the day, and I still think it was incredibly bullish that we closed ever so slightly higher than that massive semiconductor rally we saw on Thursday. That being said, I am constructively bullish, especially as we exit the window of weakness, and until we break 49.44 on a daily basis, 47.80 on a weekly basis, all opportunities, all dips to me are simply buying opportunities for higher price action, 5,100, 5,200 and above. Now, this is the weekly chart for the equal weight. Now zooming in to price action, looking at candle structure and location, very similar to the S&P 500, you can see we got a very strong green bodied candle with a minimal lower wick and a minimal upper wick. Very, very bullish when you look at this, and you can actually see in the last 5 to 10 weeks, this is by far the strongest candle we've made, and that's a very, very bullish sign. Bears immediately found value right here, bought at the lows, but that's also where we opened the week. So we traded ever so slightly lower Monday, Tuesday, and then after the Nvidia news, we rallied all the way up. Now on a weekly basis, this chart is actually looking fairly bullish. We did put this lower low in here, but then we actually made a higher high against this high right here. We then actually did pull back, put in a low right there, a higher low compared to that, and then we did go put in a higher high right there against these levels right here. So very bullish and constructively bullish price action when you look at it. And on a weekly basis, we can actually afford a pullback in the RSP all the way to as far as the 155 level. And if we actually measure how far we are away from that level, from the close of this week all the way to there is 4.22% in the RSP. And as long as we stay above the 155 area, we can be constructively bullish and look for buy side opportunities to the upside. The reason why this is also a key level is because it's part of this multi-year base that we formed in the S&P 500. You can see that there was a ton of price action here. It was a heavily traded zone, as well as wicked right here, and resistance becomes support. And that's why if we do pull back to 155, we will look for opportunities, especially on the weekly chart. And to be honest, we can go as low as 153 to the end of this week, but we don't want to break below this wick right there. But we did see strong buy side support come in at this wick. At the same time, if we do zoom in, we also saw buyers found value right here, here, and here in the RSP. And this zone, very much like the 49.20, 49.30 zone in the S&P 500, is where buyers definitely found value and definitely came in, bought the dip, looking for higher price action. Now zooming out, looking at the bigger chart, what levels can we look at as the S&P 500 approaches all-time highs? Well, it's very, very obvious. The next level is this wick right there, and then the new all-time high wick at 164. And if we measure how far we actually are from those levels, we're about 1.72% away, and we can definitely go ahead and hit those highs in the RSP. Looking at the daily chart, zooming in, we can see Friday's close. There was a lot of indecision in Friday's close, at least on the day's trade, but we did gap up and we did finish slightly in the green. All things considered, it was a green bodied candle. Now on a weekly basis, I said we can afford a pullback to the 155 level, but it's a bit different on a daily basis. I think on the daily chart, we can actually look to 158 as a key support zone where we can afford a pullback and look for opportunities. Below 158, we could probably make our way to the 155 level. Maybe we will find strong support right here at these levels. You can see there's a ton of wicks right here, but until we actually go ahead, break 155 and maybe even this 153 level here in the RSP, all dips should be bought, but it just depends. Do we pull back and go higher right here, or pull deeper into the 155 level and then find buy side support? We are exiting the window of weakness. Positive gamma is abundant in the tape, and that should support the RSP and the market as a whole. We are 1.72% away from all-time highs, and we've actually broken out from this base we formed right here. This is constructively bullish price action, and what I want to see the RSP do is push this week all the way to the 164 level. If it can do that, make a new all-time high, that is going to be constructively bullish for the market as a whole. Now looking at sectors, and guys, we all know what happened Wednesday, right? Nvidia reported earnings. You can actually see here that semiconductors were the worst performing sector. I mean, apart from software, the second worst performing sector on Wednesday. After Nvidia's earnings, it's the best performing sector, and it stayed there for a week, increasing in value as well. Other than semiconductors, you know, we had like staples, materials, healthcare, financial. So it was sort of mixed across cyclicals, sensitive sectors, defensive sectors. And normally when we get this type of price action where there's no real like industry leading, it just leads to a broadening out. We saw quite a number of sectors outperform the SPY, and quite a number of them underperformed the SPY, including technology, energy, comm services, and software as a whole. Regional banks continue to be an absolute dumpster fire, and GDX showed remarkable strength towards the end of the week right here, powering a lot of the losses it had earlier on in the week. Now, let's have a look at sentiment. These are two sentiment indicators we look at every single week. The BofA Bull Bear indicator stayed at 6.6. The Goldman Sachs sentiment indicator ticked up to 1.33. Something I want you guys to note about this indicator is that when we get to stretched positioning, we normally actually stay there for quite a while before we do get dips back down to this level. So we can actually stay in this stretched positioning level for quite a while before we do see positioning change. That being said, the sentiment across these two assets is probably still hold for the most part. So if you're holding stock, hold stock. And if you have like big winners in your portfolio, maybe trim them a little bit and go into other sectors that you're under allocated to. That's probably the prudent thing to do with your portfolio, or just build up some cash. And here's another sentiment check. Now this is the S&P 500 performance in the last 12 months. After December, January, and February are each positive. So we get a very positive turn of the year. What can we expect? And this is kind of crazy. This has occurred 25 times. At the end of 12 months, 25 wins, 0 losses, average return 16%. And apart from 2011, where we saw a negative 17.2% drawdown, the drawdown is actually no less than 10%. So again, guys, if we do get a 4, 5, 6, maybe 7% pullback, that actually might all we get for the year, at least according to history, according to the stats in similar periods. And we look at the max draw up here, we can see 30.8%, 28%, 14%, 16%. Every single year was double digits except 3 here in 1993, 2004, and 2011. Other than that, every single year had double digit draw ups from the lows. So any pullbacks, even a 5% pullback, should be looked at as a possible dip buying opportunity, because when we get these types of rallies, pullbacks are far and few between. So we're going to have a look at a couple of sentiment checks that we have here. This is data from BofA. Very interesting stuff, just to see where the head's at for these fund managers, financial advisors, and what they believe the economy and the market's going to do, and how they're thinking and how they're positioned. Now, fund managers were asked, how bullish or bearish are you over the next 3 months and 12 months? This dark blue is 3 months, this light blue is 12 months. 1 represents extremely bearish, 10 extremely bullish. And you can see that in the near term, fund managers don't expect much of anything. They're kind of neutral, I would say, in the next 3 months. But over the next 12 months, the majority of participants are sort of in the 6, 7, 8, 9, some even 10 category. So in the near term, they're neutral. Over the next 12 months, they're fairly bullish. Really interesting data here from BofA. Fantastic data, actually. Now, another fantastic data point is, where do you think we are in the business cycle within the US? Now, there's actually no conviction when you look at it. All fund managers are spread between early cycle, mid cycle, late cycle, and then a small portion do think we're still in a recession, and I don't blame them. Certain industries are. I personally believe we're sort of here, early cycle into mid cycle, sort of in between. But you can see, compared to where we were in 2023, the majority thought we were late cycle. That has now shifted dramatically into most fund managers not knowing where we are. And to be honest, based on everything we've seen, it's really hard to determine where we are in the cycle, just because of how bonds, rates, equities, real estate, the labor market have all reacted to the economic environment we're in. There's just a bunch of confusing signals all over. Now, another great data point here. When do fund managers expect the US equity market will peak? 77% of them said beyond 2024. In other words, 2025 onward is when they expect the market to peak, which means they probably are expecting higher price action through most of 2024. Only 1% of fund managers believe it's already peaked. And then we have 10% and 11% saying in the second half and first half of 2024, respectively. So the majority do believe we're probably going to get higher price action from where we are right now. Now, what about a recession? What is your view on the US economy in 2024? 51% of fund managers believe that we're going to get below trend GDP plus disinflation, so a soft landing. And then 31% believe above trend GDP and disinflation, so no landing pretty much. This is kind of surprising. 10% of fund managers believe that in 2024 we're going to enter a stagflationary environment which is below trend GDP plus higher inflation. That's very, very interesting. And then the remaining 8% of asset managers believe recession and then above trend GDP plus inflation. And in this case, I actually take the contrarian view. I think we're going to get above trend GDP plus inflation at around 2 to 3%. That's what I think. So I'm actually a contrarian in this regard. I think rate cuts and election year government spending is really going to spur GDP to the upside. We may pay for it down the line, 2026, 27, but in the year and now, that's just my opinion. So with all of that in mind, how are fund managers allocating their portfolios? Well, you can see that the average bond allocation in 2024 is at 26% and the average equity allocation is at 59%. So they're holding about 60% in equities, but not quite 40% in bonds, about 26% in bonds, and probably the rest is sitting in like alternative assets, cash as well. There's actually a number of assets that you can invest in besides bonds. And I do think that after the 2021-2022 bond rout, we saw, bonds falling peak to trough 30-40%, especially in the longer duration. A lot of people will probably be shaken out of their bond trade and looking towards other assets. Gold, private equity, private credit is a pretty big investment vehicle right now. You can get like guaranteed 12% returns in private credit. But equity allocation is still below trend, but at about the 60% mark, which is historically the average going back decades and decades, even as far back as 1920. Now, where does that leave us with valuation? The next 12-month PE for the S&P 500 is at 20.7, and we could see that it's trading at a 1.4 times PEG ratio and 3 times EV to sales on a 3.5% free cash flow yield. You take into consideration the 10-year trades at 4.2% right now. The cheapest sector on a PE basis is energy, but on a PEG basis, right now, it's actually comm services and healthcare. So if you are looking for growth, probably go comm services, healthcare. I wouldn't mind infotech as well, but comm services and healthcare is where the growth is right now. If you're looking for value, look at energy. They're producing a ton of free cash flow. But all in all, as we continue throughout 2024, the market is increasingly becoming expensive on a price to earnings basis. That being said, valuation is never a reason to not buy a stock. It's also never a reason to sell a stock. It's just metrics we can use to compare like for like. At the end of the day, if you're looking really long term and you're investing for the long term, which I do believe most of you should, and that's what I do, none of these should really matter, and you should really just dollar cost average into the market. That way you invest at the lows, invest at the highs, and take advantage of the full market cycle. Now guys, we're going to be looking at some charts, but it's going to be a little bit different than what I would usually do. We're going to be looking at an instrument versus the S&P 500, and essentially this is what it's going to look like. So we'll have the QQQ right here, and if the chart is going up, that means the index or the instrument is outperforming the S&P 500. If it's going down, that means the S&P 500 is outperforming the instrument. You can see this right here. If the chart is moving sideways, that means the performance between the S&P 500 and the index or indice or instrument is exactly the same. These charts are about 12 to 18 months in length, so do take into consideration that the S&P 500 in the last 12 to 15 months has been about 27 to 30%. So if the chart looks relatively flat, it's actually performed really, really well. And you can see QQQ has outperformed the SPY, and we can see this with high lows, and this chart sort of making its way to the top left from the bottom right here. Now, looking at semiconductors versus the SPY, complete outperformance, outperforming the SPY for the most part, and actually seen acceleration to the upside here since early 2024, late 2023. Looking at consumer discretionary, relatively flat when you look at the chart like this, but we did see major outperformance through most of 2023. But as we have had underperformance in Tesla, this has come down, and Tesla does make up a huge part of the discretionary sector. Looking at staples, the S&P 500 has just outperformed staples for the better part of the year. We can just see from the top left to the bottom right. And while it might not have been a bad investment, the S&P 500 would have been a far superior investment. Technology, XLK, very similar to the Qs, and semiconductors, complete outperformance relative to the S&P 500. And that's because it just has a higher beta. The same thing with comm services. The two biggest names in here is Google, Meta. They also have Netflix, Disney, and a bunch of other stocks like AT&T, Verizon, which have actually done really well. And they're at like 52-week highs, some of them new all-time highs. But what we are starting to see is that from about this peak right here, we've actually been relatively flat, and we have seen the S&P 500 outperform comm services as a whole. Looking at financials, if you look at it from a year basis, the S&P 500 has outperformed. But if you go from about June, July last year all the way to now, financials have handily outperformed the S&P 500, and you're also collecting like a 2 to 3% dividend at the same time. Now, industrials hasn't performed really well, especially as that manufacturing recession happened here in early 2023. But if you actually look at it from this low, relatively speaking, industrials and the S&P 500 have performed relatively flat, and we have sort of formed a bottom here against the SPY. Industrials have outperformed lately. For most of 2024, end of 2023, industrials have kind of outperformed. Industrials is also the most correlated sector to the S&P 500. So we generally do see the chart move flat over the long term. So when we do see drops like this, it's more of an underlying weakness in manufacturing more than it is the global economy. That being said, the S&P 500 has outperformed industrials, but hopefully we can see more of this sideways movement in industrials where they both perform really, really well. Looking at real estate, this has been an absolute dumpster fire. For shareholders. And the thing is, when rates are increasing, real estate is just not going to perform that well because this entire sector is built on loans, credit, mortgages. When the cost of capital increases, it just puts pressure on margins, top line and bottom line. Looking at regional banks, from the start of the chart to right now, the S&P 500 has outperformed regional banks, but we've seen some major volatile swings relatively speaking. And had you actually bought the lows, you would have outperformed the S&P 500 for the most part, especially if you close at the highs in each instance. But that being said, to hold this specific asset against the S&P 500, it requires a lot of grit because there's a lot of volatility here in regional banks. Now, this is utilities, very similar to consumer staples. The S&P 500 has just outperformed for the most part through and through, and you're better off holding just the index as a whole versus the utility sector. Now, looking at healthcare, the S&P 500 again outperforming the healthcare. This chart is moving low, but we are sort of seeing a bottom put in here, and the healthcare earnings are expected to tick up, and maybe we should see outperformance in healthcare, especially from mid 2024 onwards. Now, this is GDX gold miners, and in an environment where rates are increasing, gold miners and gold as a whole is always going to underperform because cash becomes relatively more attractive. You're getting a higher yield, making your dollars more valuable, and that's why we've just seen the S&P 500 outperform gold as a whole. Looking at the energy sector, a very volatile trade. Had you bought the top year against the S&P 500, you would have severely underperformed the market. And I think that's because for most of 2023, energy was flat, maybe even down on the year, whereas the S&P 500 was up 26%. And you can clearly see this. However, again, a bottom is starting to form here against the S&P 500. And I am bullish on energy for the rest of 2024, 2025. But it really needs to pick up steam against the S&P 500 because even though energy has performed really, really well in 2024, the S&P 500 has also performed really well. Now, looking at Europe, the stock 600, we can see that we did outperform for most of 2023, but we're kind of forming a bottom. Still mild outperformance in the S&P 500, but the stock 600 is starting to tick up. And I do think Europe earnings are going to come in really good in 2025, and this may actually be a really good place to go ahead and buy European stocks if you're not invested in that asset class. Hang Seng, the worst of the worst dumpster fires, literally just going down across the chart. Anyone in Chinese stocks over the last year, 2 years, maybe even 3 years has not done very, very well at all. Now, looking at the ASX 200, the Australian index, however, the ASX has actually performed relatively well. You would have produced a lot of alpha. You can go collect an 8% dividend, get like 3 to 4% capital appreciation. But in that, only getting 11% for the year. The S&P 500 is 30% plus. It's why the S&P 500 outperformed the ASX 200. Looking at the Nikkei, very volatile respectively. Had you bought the lows, you were doing very, very well. But from a open to close basis, the Nikkei 225 has outperformed the S&P 500. Now, we have a very, very dense week of earnings. And if your portfolio is positioned in like software infrastructure, as well as like consumer goods, we're looking at like discretionary XLP staples, I think you're going to have a very volatile week. We have stuff like Zoom, Workday, HIMS reporting their earnings. We have Lowe's, AutoZone, Shift4 Payments, Splunk. Then we have big names on Wednesday after the close, Marathon Digital, Snowflake, Salesforce. Then we have stuff like Autodesk, Dell, Fisker, Zscaler, Celsius, Thursday before the open. Then Friday, Fubo TV, Plug. A very, very dense week of earnings. Now, before the open on Monday, we also have Berkshire Hathaway reporting earnings, but Buffett already dropped his earnings, so let's have a look at it. So for the financial year 2023, Warren Buffett produced $364 billion in revenue, a 21% year-over-year growth that led to net profit of $97 billion and investment unrealized gains of $74.9 billion. That is absolutely crazy. Operating profit, I believe, for his insurance and railroad segments was $8.4 billion, and net income increased 107% year over year to $37.5 billion. Now, the reason why you have such variability in this is simply because of the way GAAP accounting is reported. That being said, I think earnings are very good and the stock should get a bit of a pop on Monday's open. Great earnings and Buffett continues to outperform. But the big takeaway here, guys, is that Berkshire and Buffett are sitting on $168 billion in cash and short-term securities. And not just that, they're also sitting on $170 billion of insurance float. So essentially, Buffett has like close to $400 billion, $380 billion of cash that he could really use to go ahead and virtually buy almost any company in the world if he really wants to. Now, here's something very, very interesting, right? Buffett estimates the replacement value of BNSF, so his railroad company, it's Burlington North Santa Fe Railroads, at $500 billion, right? Let's be conservative, say it's $200 billion. He holds $160 billion in cash, $360 billion in equities. So that puts that total value right there at like $710 billion. That means the remaining market value of all of his businesses is equal to $190 billion. These are the same businesses that would produce $320 billion in revenue, only valued at $190 billion. That's crazy. I think Burke is still cheap relative to the market value, and I think it only trades at about a 10 or an 11 PE, something like that, forward estimate. So I think if you're looking for like a stock that's cheap, you want to get equities at a reasonable price, go ahead and buy Burke. You know, you're going to get a huge allocation to like Apple, Coca-Cola, as well as highly profitable businesses. So not a bad investment, especially with the amount of cash on the balance sheet there of Berkshire Hathaway. Now, looking at data in the week ahead, guys, the focus will be on personal income outlays, GDP, and then sentiment. We got the big one here, PCE, headline and core. That's being released on the 29th. And then a few of the other ones. We got like durable goods, consumer confidence, mortgage applications, initial jobless claims, a sentiment on Friday, construction spend, ISM manufacturing. So a dense week of earnings, a dense week of data. And we also have a ton of Fed speakers, Bostic, Collins, Williams. They're all speaking this week, guys. So it's going to be a very volatile week, especially if you're positioned in discretionary, staples, or software. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, guys, and leave a comment. Cheers.